Your S&P 500 investments are expected to return 12% annually, but your mortgage only costs 6.37%. That's a 5.63% opportunity cost spread, and it gets worse when you factor in capital gains taxes. Today, we're breaking down whether liquidating investments to pay off your mortgage actually makes financial sense in 2026. The short answer: liquidating investments to pay off your mortgage costs you an average of 8.63% to 10.63% in opportunity costs and taxes combined. Here's why this matters. The average U.S. mortgage balance right now is $258,114, locked in at a 6.37% interest rate as of May 2026. When you liquidate investments to pay this off, you trigger capital gains taxes immediately, ranging from 15% to 20% for most middle-class earners. But that's not even the worst part. You're also forfeiting future investment growth. Your money could be working for you in the market, but instead, you're using it to pay down debt that costs less than your investments could earn. The psychology feels great. Imagine owning your home free and clear, but mathematically, you're leaving money on the table. Let's talk taxes, because this is where most people get blindsided. Long-term capital gains taxes in 2026 are tiered by income. If you're a single filer earning under $49,450, you pay 0%. Between $49,450 and $519,900, you're at 15%. Above that, it's 20%. For married couples filing jointly, it's 0% up to $98,900, then 15% up to $623,000, then 20% above that. But here's the hidden trap. High-income earners face an additional 3.8% net investment income tax on top of those gains if your modified adjusted gross income exceeds $200,000 for single filers or $250,000 for married couples. This was enacted as part of the Affordable Care Act. So a $100,000 investment gain could cost you anywhere from $15,000 to $23,800 in total tax liability, depending on your income level. That's real money disappearing before you even pay off a single dollar of your mortgage. This is the core of the entire argument. Your mortgage costs 6.37%. What are your investments earning? According to RBC Wealth Management, the S&P 500 returned 17.9%, including dividends, in 2025. That's more than double your mortgage rate. Now, 2025 was exceptional, but even looking forward, Goldman Sachs research projects the S&P 500 will deliver 12% total returns in 2026, with earnings per share expected to increase 12%. And historically, the S&P 500 averages 10% annually since inception, according to Fidelity. That's substantially higher than any mortgage rate available in 2026. So unless your portfolio is somehow earning less than your mortgage costs, you're mathematically ahead, keeping both your investments and your mortgage. Let's compare your actual options. Strategy 1. Keep your investments and your mortgage. You earn a 5.63% spread. Your investments return 12% while your mortgage costs 6.37%. That's free money from the interest rate differential. You don't trigger capital gains taxes, and you maintain flexibility for tax-advantaged retirement accounts. Strategy 2. Liquidate to pay off. You immediately trigger 15% to 20% in capital gains taxes. You forfeit future growth, and you lose that 5.63% spread. Strategy 3. Accelerate payments. You reduce interest paid, but you still waste the opportunity cost. Strategy 4. Refinance. You might lock in lower rates, but that requires refinancing approval and may not even be available depending on your credit and equity. For most people in 2026, keeping your investments while maintaining your mortgage is mathematically superior. This is why the math doesn't work in 2026. Head over to wealthwire.com to read the full breakdown. We've linked it below, where you'll also see how millennial mortgage debt compares to other generations and why the rising rate environment makes your current 6.37% mortgage even more valuable. Subscribe for more grounded personal finance analysis that actually uses the math. All sources are in the description.